So what is happening with Palantir? That is the question everybody asks the moment a stock they love stops acting like a hero and starts acting like a problem. The stock is down. People are nervous. The headlines get louder. The critics come back out of hiding. And suddenly investors who were speaking with total confidence a few months ago start using words like trim, danger, disruption. Maybe this is the end. Maybe the bubble is deflating. Maybe the whole journey has changed. I understand that feeling. There is nothing fun about watching a favorite stock bleed red while every voice around you sounds more certain by the hour. But before I say a single thing about critics, market fear, valuation, or Palantir itself, I need you to do something most investors refuse to do when they are emotional. Zoom out. When in doubt, zoom out. If you do not zoom out, you will always become the prisoner of the last 6 candles on the chart, and that is how people lose. Because if you only stare at the recent decline, you think the whole story is breaking. If you zoom out far enough, you realize the recent decline may be nothing more than a tax on weak conviction over the last year. The stock is still dramatically above where it was. Over the last 5 years, long-term holders are not sitting there wondering whether they made a mistake. They are sitting on gains most investors would call life-changing if they had the patience to hold through the ugly stretches. That does not mean the current pain is fake. It means context matters. And once you put the recent fall inside a wider time frame, the real question changes. It is no longer why is the chart red this month? The real question becomes, is the business deteriorating, or is the stock price simply moving through one of the recurring fear cycles that every high-growth company eventually faces? That is the whole issue. Not whether some loud critic sounds persuasive, not whether the market had a bad week, not whether your emotions enjoy drawdowns. Is the business getting weaker or stronger? That is the question long-term investors live or die by. And I want to be plain with you. I do not care what the crowd feels about Palantir this month, unless those feelings can be connected to real damage inside the company. Because if the stock price is declining while the business itself is accelerating, then that is not a reason to panic. That is the kind of disconnect serious investors wait years to exploit. So let us walk through it carefully. There are really only 2 possible explanations for what we are seeing. Either the recent decline is mostly about external fear, broad market pressure, macro headlines, AI sell-off sentiment, geopolitical stress, and all the emotional junk that gets piled onto growth stocks whenever uncertainty rises. Or the decline is company-specific, meaning the critics are right, meaning the product is being disrupted, the moat is thinning, the margins are compressing, the growth is slowing, the talent is leaving, the forecast is weakening, and the market is simply reacting to damage that is already underway. That is the choice. And once you frame it that way, the noise starts getting much easier to sort. Now, one of the biggest bearish voices in this conversation argues that Palantir is not as secure as people think, and that newer AI players could take meaningful business from them. Fine, that is a fair argument to make. I do not live in an echo chamber, and I do not want to. A healthy market needs disagreement. A serious investor should always welcome criticism. If nobody pushes back on your thesis, you probably do not have a thesis. You have a religion. So I am not upset that people disagree. I actually want them to disagree, because criticism serves 2 purposes. First, it forces you to sharpen your own analysis instead of hiding inside blind loyalty. Second, if the criticism turns out to be wrong, it often gives you lower prices before the market catches up to the truth. That is not a bad arrangement. But disagreement only becomes useful when it is tested against facts. And this is where most people fail. They hear an argument, then immediately react to the personality, the fame, the tone, the drama, the confidence, or the reputation of the person making it. That is lazy thinking. I do not care how famous the bear is. I care whether the numbers validate the bear. That is where we begin. Now, to put the criticism in the simplest terms possible, the bearish case says Palantir could be disrupted by more general AI competitors. I understand why that sounds persuasive to people who are, but in my eyes, that is like telling me a toothbrush is about to destroy a professional painting business. Can you technically paint a house with a toothbrush? Of course. Can you get an outcome of some kind with enough time, enough patience, and enough absurd persistence? Sure. But nobody serious is going to tell me that this scales, that it is more efficient, or that it actually replaces the specialized system built for the specific job. That is the difference. General AI tools can be extraordinary in many contexts. That does not mean they eliminate the need for a company built around deep integration, defense, grade workflows, highly specific enterprise deployment, and operational systems that plug directly into mission-critical environments. A toothbrush can still sell very well. That does not make it a substitute for a commercial painting operation. And before somebody gets confused, I am not telling you to buy anything based on a metaphor. I am telling you the metaphor highlights the key test. Substitution must show up in the numbers. If a competitor is truly eating Palantir alive, then I should not have to guess. I should see it. Revenue growth should be slowing. Margins should be compressing. Big contracts should be disappearing. Management should start hedging instead of projecting with confidence. The balance sheet should look worse, not better. Returns on capital should flatten or decline. The people who know the business best should be leaving. That is what disruption looks like in a public company, not a clever article, not a dramatic phrase numbers. So let us talk numbers. If a company is being quietly dismantled by competition, one of the first places it shows up is revenue. Sales stop growing the way they used to. The story gets weaker before the stock usually admits it clearly. But what do we actually see here? We see very strong revenue growth, not a company limping along, not a business trying to explain away stagnation with hopeful language, strong top-line expansion. That matters because you cannot keep selling me the story that the product is becoming irrelevant while the actual demand curve keeps accelerating in the real world. Then look at margins. This is where weak businesses get exposed quickly. A company under real competitive pressure often has to give up economics to protect demand. Prices soften, sales costs rise, operating leverage weakens, margins get squeezed. That is how math tells the truth even when management tries to spin. But that is not what we are looking at. Operating profitability is not collapsing. It is expanding. And when margins rise even as revenue rises, that tells me something very important. The business is scaling. Scaling is the holy grail. If a company can grow sales and grow profit even faster than sales, then the machine is getting more efficient as it gets larger. That is the opposite of a company being cornered. Then you come to free cash flow, which is one of the most beautiful lies detectors in finance. A company can talk to you all day. Free cash flow either shows up or it does not. This is why I do not build conviction on stories alone. I want to know whether the company turns its business into real surplus cash after running the operation. And here again, the numbers are powerful. This is not some speculative outfit burning money to keep the dream alive. The company is generating meaningful free cash flow, and that free cash flow is growing strongly. Again, that is not what competitive collapse looks like. Now, let me show you the part that makes me almost laugh when people describe the company as fragile. The balance sheet. There are balance sheets that are decent. There are balance sheets that are good. There are balance sheets that tell you management is responsible. And then there are balance sheets so absurdly strong that they destroy whole categories of bearish talking points in one glance. Palantir sits on a mountain of cash relative to debt that matters enormously, because it means this is not a company one bad quarter away from funding stress. It is not a company forced to beg the market for oxygen. It is not trapped by interest expense, weak liquidity, or a capital structure that turns every stumble into a crisis. If you have huge cash, limited debt, and positive free cash flow, then your ability to survive, adapt, out-invest, and wait out weaker competitors becomes much stronger. That is what the balance sheet is buying you time. And time is what weak companies never have enough of. Now look at the scorecard of the business more broadly. Growth, profitability, liquidity, scalability, return metrics, institutional ownership, all the areas that separate a real operating machine from a market fantasy. The profile is elite, not perfect. because nothing is perfect, but elite. And I want to emphasize that because people often confuse high price volatility with weak business quality. Those are not the same thing. A stock can be wildly volatile because expectations are emotional. A business can still be excellent under that volatility. That is why I always go back to the same framework. Separate the chart from the company, then decide whether the chart is wrong about the company or the company is proving the chart, right? Now let me take you deeper into the actual operating trend, because this is where the bear case becomes very hard to defend unless you simply refuse to look. Quarter after quarter, revenue is rising. Quarter after quarter, profit is rising. Quarter after quarter, margins are improving. Quarter after quarter, returns on assets, equity, and capital are strengthening. That is not random. That is not luck. That is not a business being slowly hollowed out by some new threat. Nobody else has noticed. That is what execution looks like. And when you get this particular setup, business metrics moving up while the stock price is moving down, you are looking at the kind of divergence that creates the entire reason long-term investing exists. If both the stock and the business are deteriorating, then lower price is not opportunity, it is warning. But if the stock is deteriorating while the business is improving, then you may be staring directly at a gap between perception and reality. That is where the money gets made, not in comfort, not when everyone agrees. In the gap, this is the same pattern we have seen before. Markets do not move in straight lines. Neither do narratives. A stock can spend months or years being misunderstood. A company can keep compounding quietly underneath that misunderstanding. And then one day, the gap closes fast enough that people who mocked your patience suddenly call it obvious. But it was not obvious when it mattered. It never is. Now, I also want you to think about how markets actually behave when fear is already elevated. If the overall market is shaky, if AI names are selling off broadly, if geopolitical stress is high, and then a prominent critic adds a company-specific bearish thesis on top of that already weak emotional environment, what happens? You get a perfect storm. You get a stock whose price gets hit from both directions at once. Macro fear from outside, narrative fear from inside, and that can produce an emotional liquidation that has very little to do with what the operating business is doing right now. That is exactly why I keep saying that these are the moments when conviction matters. Not fake conviction, not message board conviction. Real conviction built on your own work. Because if your conviction is borrowed from someone else, then the next article, the next red week, the next ugly chart, the next dramatic headline will take it away from you just as easily as it was handed to you. That is why I never want anyone buying a stock because I like it or because a bear hates it. You have to build your own case. Otherwise, you are renting confidence, and rented confidence always expires at the wrong time. Now, let us talk about institutional ownership, because this part always interests me. I care far less about what institutions say than what they actually do. Talking is cheap, buying is not. And while a great many people spent the last few years telling retail investors that the valuation is dangerous, the actual institutional ownership kept climbing. That should make you pause. Because once again, we have the same split public language on one side, real positioning on the other. Now, I am not telling you to worship institutional money. Institutions make mistakes too, but when the story being sold to the public is stay away, too risky, too expensive, too dangerous, while the actual holdings continue climbing steadily, then you would be foolish not to ask a very basic question. Why are they buying if the story is so broken? That question matters, because professionals do not need to speak kindly about an asset to accumulate it. In fact, in many cases, they prefer the opposite. They would much rather buy while sentiment is weak, while retail is emotional, and while the narrative remains noisy enough to keep prices from running away too quickly. Again, do not listen only to what people say. Watch what they do. The chart of institutional ownership tells a story, and it is not the story of smart money abandoning a dying company. Now let us move to valuation, because eventually every great company meets the same question: how much of the future is already priced? This is where people become sloppy. The lazy bull says incredible company, therefore buy at any price. The lazy bear says expensive stock, therefore doomed. Both are intellectually weak. A serious investor tries to think in ranges. What happens in a bad case? What happens in a middle case? What happens in a truly strong case? And how much room is there between today's price and those outcomes? That is the way I think about it. Not because I know the future precisely. Because range thinking is more honest than pretending certainty exists. If the company performs terribly relative to what bulls hope, maybe the upside is modest. If the company performs well but not perfectly, maybe the upside is much larger. If the company keeps executing at an elite level and the market eventually rewards that execution, the upside can become enormous. That does not mean any one price target is sacred. It means the shape of the opportunity remains asymmetric if the business continues compounding faster than the narrative around it. And that is what I see here. The floor may not be disastrous if the company remains strong. The middle case is compelling. The bullish case is extraordinary. That is why I do not get shaken out by every article. Because the question is not, can somebody write a scary sentence about the stock? Of course they can. The question is the operating engine still doing what it needs to do to justify a long-term ownership case? And the answer, based on the figures in the source document, is emphatically yes. Now let me say something a lot of investors need to hear. A stock can be a wonderful long-term opportunity and still be miserable in the short term. Those two things can coexist. A stock can go nowhere for months while the business improves underneath it. A stock can fall hard while institutions are still accumulating. A stock can become cheaper while the actual operation becomes stronger. And if you do not have the temperament to hold through that, then it does not matter how good the business is. The market will find a way to remove you from the story. That is why I care so much about process. If you are going to own a high-growth name, you must understand in advance that fear cycles are part of the price of admission. You do not get 500% upside over a multi-year stretch without enduring the kind of volatility that makes weak hands feel sick. That is how the market filters people. It uses pain to separate owners from tourists. And I say that with respect, not contempt. Because every investor becomes a tourist at some point, unless he builds a system strong enough to withstand the weather. So what should you do with a situation like this? First, stop letting the chart make the argument for you. The chart is evidence of sentiment, not a complete explanation of value. Second, test the bear case against the actual business, not against personalities, not against social media clips, against revenue, margins, cash flow, balance sheet, strength, returns, contract trajectory, talent retention, and forecast quality. Third, decide whether the current disconnect is one you understand deeply enough to hold through. If you do not understand it, there is no shame in staying away. Confusion and conviction should never coexist in the same portfolio. But if you do understand it, if you genuinely believe the business is strengthening while the stock is weakening for reasons that are mostly emotional, cyclical, or temporary, then lower prices are not a reason to panic. They are the entire point. That is what value inside growth investing looks like. Not a cigar butt at a bargain multiple. A wonderful operating machine temporarily sold down by fear, doubt, and narrative conflict. Now, let me bring it all together. Because this is where most people need the answer stated very simply. The recent drop can be explained in two ways. Either the business is breaking or the market is mispricing a still improving business because fear has become stronger. When I look at the evidence contained in the source material, I do not see a broken business. I do not see slowing revenue. I do not see collapsing margins. I do not see a company drowning in debt. I do not see leadership exiting. I do not see forecast weakness. I see growth. I see profitability. I see extraordinary liquidity. I see improving operating quality. I see institutional accumulation. I see a strong business inside a weak emotional environment. That does not guarantee the stock goes up next week. It does not guarantee smooth sailing. It does not guarantee critics disappear. It means the long-term case is not being disproven by the numbers. And if the long-term case is not being disproven by the numbers, then the long-term investor has no business behaving like a day trader trapped inside a bad afternoon. That is the truth. You should never buy a stock because somebody says it is the next great thing. You should never sell a stock because somebody else says it is doomed. You build your conviction from fundamentals. Then you decide whether the price offers enough reward relative to the risk. Then you live with your own decision like an adult. That is investing. Everything else is outsourcing your emotions to whoever sounds most confident this week. And that is how people end up buying high, panicking low, and calling themselves unlucky. No, they were undisciplined. There is a difference. If you want to survive and maybe even thrive in names like Palantir, you need a system, a way to evaluate businesses, a way to think through volatility, a way to separate price action from operating reality, a way to hold when the thesis is intact, and change your mind only when the numbers force you to, not when the noise wants you to. Because bad times like this are not the exception in investing. They are the tuition. They are where conviction is tested. They are where long-term investors are made or exposed. And they are where some of the best entries in great businesses have historically been found, not because the fear was pleasant, but because the fear was wrong. So if you ask me what is happening with Palantir, my answer is straightforward. The stock is under pressure. The business is not. The narrative is noisy. The numbers are strong. The crowd is emotional. The institutions keep buying. The company keeps growing. And when that setup appears, price declines are not self-evident proof of decay. They may be invitations. The only question is whether you have done enough work to recognize the invitation when it arrives.